You work 9 to 5, pay 30% in taxes, but the rich, they pay 0. Why? Because they play a different game. And I'm about to show you the rules. Imagine a man named David Sinclair. Not a celebrity, not a politician, but a quiet billionaire who seems to defy the tax system. His neighbors think he must be writing enormous checks to the IRS every year. After all, he owns private jets, mansions, and a tech empire valued at over $2 billion. But here's the shocking truth. In the last 5 years, David has legally paid 0% income tax. How is that possible? Did he cheat? No. Did he exploit some illegal loophole? Absolutely not. David simply understood the rules of the game. The same rules available to everyone but used strategically by the ultra-wealthy. Most people earn money, get taxed, and then spend what's left. The ultra-wealthy do the opposite. They invest first, borrow smartly, and minimize taxable income. They operate in a financial universe that most people never get to see. In this video, we'll explore 7 key principles that explain how people like David, from Elon Musk to Jeff Bezos, can legally reduce or even eliminate their tax bills. And more importantly, we'll discuss how you can start applying parts of their strategies, even without billions in your bank account. Let's break down exactly how the ultra-rich pay 0% tax, legally. The biggest misconception about wealth is that rich people earn a lot of money. In reality, they own things that make money for them. Businesses, stocks, patents, real estate, and brands. Here's why that matters. The government taxes income, not assets. If you work for a salary, you get taxed before you even see your money. But if you own appreciating assets, say a company or investment, your wealth grows on paper, not in cash. And guess what? Unrealized gains, the increase in value of your assets, aren't taxed. David Sinclair, from our opening story, receives a salary of just $1 a year from his company. But he owns 40% of the business's stock, worth hundreds of millions. As the company's value grows, David becomes richer, without triggering a taxable event. This is the essence of don't earn, own. The tax system is built to encourage ownership because it drives economic growth. The government rewards risk-takers and investors, people who create jobs and stimulate industries. So while a regular employee pays up to 35% or more in taxes, a billionaire can technically report almost no income. They live off their wealth, not from taxable wages. To apply this principle, you don't need billions. You can start by shifting your mindset from earning to owning. Buy shares, start a side business, or invest in income-generating assets. Every step away from pure labor income moves you closer to the way the wealthy legally avoid taxes. Owning assets turns the tax code from a burden into an opportunity. The ultra-wealthy have mastered a strategy often summed up as buy, borrow, die. Here's how it works. Buy assets, stocks, real estate companies. Borrow against those assets to access cash. Die, leaving their wealth to heirs with little or no capital gains tax due to the step-up rule. Let's unpack that. When someone like David's assets rise in value, he doesn't sell them. Selling would trigger capital gains tax. Instead, he goes to the bank and borrows money using his stock as collateral. Banks happily lend at low interest rates because his assets are worth billions. The loan isn't income, it's debt, and debt isn't taxable. So David can borrow $10 million, live luxuriously, buy homes, even reinvest, all without selling anything or paying income tax. Then when he passes away, the assets transfer to his heirs and the tax basis resets to current market value. His lifetime gains? Never taxed. Meanwhile, the average person works harder, pays taxes up front, and saves what's left. This strategy may sound out of reach, but its foundation, leveraging assets without selling, and is scalable. You can borrow against home equity, investments, or even business receivables. The key is to think like an investor, not a spender. We'll explore 5 more strategies next that tie directly into this mindset, and they'll show you why tax avoidance isn't cheating, but simply understanding the financial playbook. If there's one tax rule that completely separates the rich from the middle class, it's this. Not all income is taxed equally. Most people earn what's called ordinary income, wages, salaries, freelance payments, all taxed at rates up to 35% or more. The ultra-wealthy, however, structure their income to fall under capital gains, which is taxed much lower, sometimes as little as 0% to 15%. Here's where it gets fascinating. David Sinclair, our quiet billionaire, doesn't get a big paycheck. Instead, when he needs to show income for financial or personal reasons, he sells small portions of his long-term investments, assets he's held for more than a year. That's key. The U.S. tax system rewards patient investors. If you buy and hold, your profits are taxed at the long-term capital gains rate, far lower than ordinary income. But if you flip, trade, or sell too quickly, you're taxed heavily just like a regular job earner. So David plays the long game. He buys quality assets, waits, and lets time do the heavy lifting. When he sells, his tax bill is minimal, or even zero if he uses other offsets like losses or deductions. Let's simplify this with an example. Imagine two people: Emma, an employee earning $200,000 a year; Liam, an investor making $200,000 in long-term capital gains. Emma's paycheck gets taxed before she even touches it. After federal, state, and payroll taxes, she might keep about $120,000. Liam, on the other hand, may owe only about 15% on his capital gains, keeping around $170,000. Both made the same nominal amount, but Liam walks away with $50,000 more simply because of how he earned it. Now multiply that difference over years, decades, and billions of dollars, and you see how the ultra-wealthy quietly build and preserve empires while others feel stuck on the hamster wheel. But the secret goes deeper. Capital gains can often be deferred or eliminated through smart strategies. 1031. Exchanges in real estate allow investors to sell properties and reinvest profits into new ones without paying tax immediately. Qualified opportunity zones give tax breaks to investors who fund development in low-income areas. Charitable remainder trusts, CRTs, let you donate assets, receive income, and drastically reduce taxes all at once. In short, capital gains are the gentle breeze that propels the rich forward, while ordinary income is the headwind that slows everyone else down. So, what's the lesson for you? Even if you're not sitting on millions in stock options, you can still tap into this principle. Start investing, and even small amounts, in assets that appreciate over time. Think like an owner, not a trader. Buy index funds, real estate, or shares of companies you believe in and hold them. The longer your time horizon, the lower your tax burden. Remember this golden rule. Wealth favors patience. The tax code rewards those who delay gratification, who plant seeds today and let them grow quietly in the background. That's the essence of how the ultra-wealthy turn time into money, and taxes into opportunities. If there's a single tool that separates the financially enlightened from everyone else, it's the corporation. To most people, a corporation is just a company, paperwork, a logo, maybe an office. But to the ultra-wealthy, it's a protective fortress, a shield that legally redirects taxes, expenses, and liability. Let's revisit our quiet billionaire, David Sinclair. David doesn't own his yacht, cars, or even his private jet personally. His holding company does. The same company owns the intellectual property of his brand, stakes in his investments, and several subsidiaries that manage real estate and tech ventures. Why? Because corporations are tax-advantaged machines. They pay taxes differently, and often after expenses, not before. If you earn as an employee, your income is taxed first and whatever remains can be spent. If you earn through a corporation, you spend first, deduct legitimate business costs, then pay tax only on what's left. Think about that for a second. David's corporation can legally deduct office space, even if it's in his home. Travel expenses, business meals, and networking events. Equipment, staff salaries, marketing, software, and vehicles. Even parts of his luxury lifestyle, as long as they serve a genuine business purpose. So while an employee uses after-tax money to pay for similar things, David does it pre-tax. The difference is massive. Here's where it gets more strategic. The ultra-wealthy rarely rely on one company. They create layers of entities, holding companies, LLCs, limited partnerships, and trusts, all serving different purposes. Each entity can shift income, manage risk, and optimize tax exposure. For instance, David's tech firm might pay royalties to his intellectual property company, which is based in a lower tax jurisdiction. That payment becomes an expense for one entity and income for another, legally reducing overall taxes. The same happens worldwide, from Silicon Valley to Dubai. where global corporations structure earnings across borders to minimize tax drag. But here's the part that's often misunderstood. This isn't tax evasion, it's tax design. The tax code was written to reward business creation, innovation, and investment. Every deduction and corporate benefit exists to incentivize economic activity. Governments know this. When entrepreneurs succeed, they create jobs, pay payroll taxes, and boost GDP. In return, they're given tools to reinvest more efficiently. Now, can an average person do this? Absolutely, just at a smaller scale. You can create a simple LLC or corporation to manage your freelance work, consulting, or online business. Even a small side hustle qualifies. That allows you to write off legitimate expenses, your laptop, internet bill, travel to conferences, courses, and software, before paying tax. The principle is simple. Be the business. Don't just work for one. Owning a corporation changes your identity in the eyes of the tax system. You stop being a consumer of income and become a creator of value. That's where the magic happens. Here's a fun perspective. Warren Buffett once admitted he pays a lower effective tax rate than his secretary. Why? Because his income flows through dividends and corporate structures that benefit from capital gains and pass through tax rules, not a W-2 paycheck. So next time you hear the phrase rich people don't pay taxes, remember, they do. Just not the way most people expect. They choose when and how to pay, through systems designed to reward entrepreneurship. And you can too. Form a small entity. Track your expenses. Deduct ethically. Reinvest what you save. Each dollar saved in taxes is a dollar that can compound for your future. The corporation is not just a business tool. It's a mindset. It's the moment you stop playing defense and start playing offense in the wealth game. If the stock market builds fortunes, real estate preserves them, and for the ultra-wealthy, it's one of the most powerful tax shelters ever created. Meet Olivia Grant, a self-made millionaire who started as a real estate agent. Within 15 years, she owned apartment buildings worth tens of millions. Yet her tax return showed almost no taxable income. How? She used the same laws available to everyone, the rules of depreciation and leverage. Let's start with depreciation. The government knows that buildings wear out over time. Roofs leak, plumbing rusts, walls fade. So it lets owners write off a portion of a property's value each year as a non-cash expense. That means even though Olivia's properties might appreciate in market value, on paper they appear to lose money annually. Those paper losses reduce her taxable income, even though her bank account is growing from rental cash flow. Here's a simple illustration. Suppose Olivia earns $500,000 in rent from her buildings, and after real maintenance and mortgage payments, she's left with $200,000 in profit. Normally that would be taxable, but depreciation might allow her to deduct $180,000 of wear and tear. Now her taxable income drops to just $20,000, and she might owe only a few $1,000s in tax. That's not a loophole. It's a built-in incentive for investors to provide housing and infrastructure. The next secret is leverage, using borrowed money to buy appreciating assets. When Olivia buys a $10 million apartment complex, she might invest only $2 million of her own cash and borrow the rest. The tenant's rent pays the mortgage, the property rises in value, and her ownership stake grows, all largely financed by other people's money. Here's where the tax magic deepens. The interest on that loan is deductible as a business expense, further shrinking taxable income. Meanwhile, any increase in property value isn't taxed until she sells, and she might never sell. Instead, Olivia can refinance. She goes to the bank, takes a new loan against the higher value of her property, pulls out millions in cash, and pays no tax on that withdrawal because legally it's debt, not income. That's the real estate investor's version of buy, borrow, die. She buys appreciating assets, borrows against them to live and reinvest, and when she passes away, her heirs receive the properties with a stepped-up cost basis, meaning all those years of appreciation are wiped clean for tax purposes. Now let's talk about 1031 exchanges, another gem. If Olivia ever decides to sell a building, she can roll the proceeds directly into another property, bigger, newer, better, and defer paying capital gains tax indefinitely. She could repeat this process throughout her life, growing her empire without ever writing that huge tax check. And if she adds a cost segregation study, she can accelerate depreciation, front-loading deductions to minimize taxes in the early years when cash flow matters most. Every rule she uses was written to encourage investment in housing, commercial development, and community growth. The government gets modern buildings and jobs. The investor gets rewarded for providing them. So what's the takeaway for you? Even on a small scale, you can apply these principles. Buy a duplex and rent one side. Invest in REITs that pass through depreciation benefits. Use mortgage leverage wisely. Keep every receipt, log every maintenance cost. And understand that real estate isn't just bricks and mortar. It's a financial instrument with built-in tax advantages. When you realize the tax code favors investors who create value, you start seeing real estate differently. It's not just about owning property. It's about owning a cash-flowing tax shelter that works day and night. In the world of the ultra-wealthy, real estate is the silent engine that compounds wealth tax efficiently, brick by brick, deduction by deduction. When most people think about billionaires and charities, they imagine generosity, acts of goodwill that change the world. That's true, but there's another layer to the story: strategic philanthropy. For the ultra-wealthy, giving isn't just a moral choice, it's also a powerful financial strategy. Let's talk about Eleanor Hartman, an investor and tech philanthropist. She donated over $200 million to education and healthcare initiatives in a single decade. To the public, she's a hero. Behind the scenes, she's also a strategist, using one of the most intelligent tax tools ever invented: the private foundation. Here's how it works. When Eleanor sets up her foundation, she contributes her assets, usually stocks, real estate, or cash, into the foundation as a charitable donation. That donation is tax-deductible. She gets an immediate reduction in her taxable income, often saving millions right away. But here's the interesting part. The foundation doesn't have to spend all that money immediately. It's required to give away only a small portion each year, in the US, typically 5% of its assets. The rest can be invested, tax-free, to grow and fund future projects. That means Eleanor keeps control over how and when her wealth is used for good, all while significantly lowering her taxes in the present. To put this in perspective, if she donates $100 million worth of stock to her foundation, she can deduct that amount from her income taxes, potentially saving $30 million or more, without selling the stock herself. And because the foundation is tax-exempt, it can sell the stock without paying capital gains tax either. She's moved money from her taxable universe into a tax-free, impact-driven ecosystem that she still influences. This isn't unique to Eleanor. It's how many of the world's wealthiest individuals, from Bill Gates to Warren Buffett, structure their giving. The Bill and Melinda Gates Foundation is a textbook example. It invests billions tax-free and distributes funds strategically to causes that align with their mission. And beyond foundations, there are other structures that work in similar ways. Donor-advised funds, DAFs, allow donors to get immediate tax deductions, then distribute the money over time to chosen charities. Charitable remainder trusts, CRTs, let donors receive income from assets during their lifetime, and after death, the remainder goes to charity, all with significant tax advantages. Public charities and nonprofits, often funded or seeded by entrepreneurs, letting them channel profits into impact projects rather than pure taxes. The beauty of this approach is in its dual purpose. It aligns impact with efficiency. Instead of writing a tax check to the government, the ultra-wealthy redirect those dollars into projects they believe in: education, health, clean energy, or innovation. It's easy to be cynical and say, they're just avoiding taxes. But look deeper, these mechanisms exist by design. The government wants private capital to support social causes because it lightens the public burden. Every hospital wing, scholarship, and research lab funded through philanthropy serves the same end goal: improving society. And here's the actionable insight for you. You don't need billions to give strategically. You can donate appreciated stock instead of cash. You can set up a small charitable fund or partner with existing nonprofits. Even small, consistent giving, and structured smartly, can create both impact and savings. Remember, generosity and intelligence are not opposites. The wealthy have simply learned to merge purpose with planning, to make every dollar do double duty, help others, and legally minimize taxes. Eleanor often says, "I don't give to avoid taxes. I give because I can do more good than a tax bill ever could." That mindset sums up why philanthropy is not only noble, but also one of the most elegant legal tax strategies on earth. For most people, death is the end of a financial story. For the ultra-wealthy, it's just the next chapter. You see, the truly rich don't just think about making money. They think about keeping it across generations. They design their financial lives like architects, building structures that protect their families from one of the most overlooked taxes of all, the estate tax, sometimes called the death tax. Let's meet Henry Wallace, a billionaire real estate mogul whose empire spanned hotels, commercial properties, and farmland. When Henry passed away at 87, the world expected his heirs to face hundreds of millions in estate taxes, but they didn't. In fact, his family paid virtually nothing in estate tax, and everything he built remained intact. How? Through one of the most sophisticated, yet perfectly legal, frameworks in the world of wealth: trusts. A trust is a legal entity that holds assets on behalf of beneficiaries, like your children or grandchildren. When you place assets into a trust, they no longer belong to you personally. They belong to the trust. And since estate taxes are based on the value of what you personally own at death, those assets are shielded. Henry used multiple types of trusts to achieve this. Irrevocable trusts, which permanently move assets out of his taxable estate. Grantor retained annuity trusts, grats, allowing him to transfer appreciating assets to heirs while paying minimal taxes up front. Dynasty trusts, which can hold wealth for multiple generations, sometimes over 100 years, compounding investments tax-free. By setting these up early, Henry essentially created a financial time capsule. His assets kept growing untouched by estate taxes, while his family continued to benefit through distributions, structured by the trust's rules. Here's where it gets even more interesting. The ultra-wealthy often pair these trusts with life insurance, a strategy called wealth replacement. When they donate or move assets out of their estate for tax purposes, they simultaneously fund life insurance policies that pay out to the family tax-free. That payout replaces the value of the donated assets while avoiding both income and estate taxes. It's the ultimate symmetry, a lifetime of giving and investing, with a legacy that endures. And remember that buy, borrow, die strategy from earlier. Trusts often handle the final step of the die part. Upon death, assets receive what's known as a step-up in basis. That means the value of investments resets to their market price at the time of death, effectively erasing all prior capital gains. The next generation can sell those assets immediately, with zero tax owed on all the growth that happened during the parent's lifetime. This isn't a loophole, it's the law, intentionally designed to keep family businesses and generational wealth stable, instead of forcing heirs to liquidate assets to pay taxes. Now, what can the average person learn from this? Even without billions, you can establish a simple revocable living trust to protect your assets and avoid probate. You can set up a life insurance trust to transfer wealth efficiently. You can start teaching your children about financial literacy and how to manage inherited wealth responsibly. Because knowledge, after all, is the greatest inheritance. The ultra-wealthy don't rely on luck or hope. They rely on structure. They don't think in years. They think in generations. Henry Wallace's family today manages his legacy through the same trusts he designed 40 years ago. The hotels still operate, the farmland still yields, and his grandchildren run the foundation that bears his name. His wealth didn't just survive him, it multiplied. That's the true mark of mastery. Not just making money, but building a legacy that never gets taxed to death. Here's the truth. The ultra-wealthy aren't playing a different game. They're just playing the same game by the actual rules. While most people are stuck in a system that taxes every hour they work, the wealthy learned early on that money follows structure, not sweat. They don't break laws and they study them. They don't complain about taxes, they design around them. David Sinclair didn't cheat the system when he owned instead of earned. Olivia Grant didn't evade taxes when she used depreciation to shelter her real estate income. Eleanor Hartman didn't manipulate the law when she built a foundation to fund education instead of writing a check to the IRS. They all understood one simple truth. The tax code is not a punishment, and it's a guidebook. You see, the government rewards behavior that builds the economy. When you invest, employ, innovate, or give, you're doing exactly what the system is designed to encourage. And that's why the ultra-wealthy don't just make money. They multiply it legally, efficiently, and purposefully. But here's the good news. You don't need billions to start thinking like them. Every journey to financial freedom begins with a single shift, from consumer to creator. Start a small business, invest in assets, educate yourself about capital gains, and learn to leverage your money instead of trading all your time for it. Each small step you take, in forming an LLC, buying your first rental property, setting up a retirement account, or donating strategically, brings you closer to playing the same game the wealthy have mastered. Remember this. Wealth isn't just about money. It's about control. Control over your time, your resources, your impact, and your legacy. And that control comes from understanding the systems that most people ignore. When you watch billionaires pay 0% tax, don't get angry. Get educated. They didn't make the rules. They just learned them earlier than everyone else. So, if you want to win in this economy, stop waiting for permission. Learn the language of wealth. Learn the structure of ownership. Learn how the system truly works. And then use it to build the life you want. Because the greatest advantage you can ever have isn't money. It's knowledge applied with discipline. The ultra-wealthy don't have superpowers. They just use tools that already exist, tools that you can start using today. So here's your call to action. Start now. Read, invest, experiment, build. Don't aim to evade taxes. Aim to outsmart them by aligning with the rules that reward creators. And one day you'll look back and realize you didn't just earn money. You built a system that makes money work for you. Remember, the rich don't pay 0% tax because they cheat. They pay 0% because they understand. Now it's your turn to understand.